But I still had a bit of a DIY mentality. So I kind of found the Investor Lab podcast, now the Dashdot Insider podcast. I found Terry Ryder's reports. I was still, kind of like, I can buy myself a tidy little property deal. I need to prove it to myself, So I went into a property in Toowoomba in its second upswing cycle, which has thankfully done well now. But, our values didn't move much for like 12 good months, which ultimately, again, slowed my progression. And that was kind of towards the latter end of where my borrowing capacity could accommodate. So, I was really pissed off. Again, the values kept coming back as like, not move. I can't get that time back. Getting it wrong was a huge opportunity cost, and time is ultimately the magic ingredient. So, at this point I was like, okay, all right. I'll get some professional help.
Hello and welcome. You're listening to Dashdot Insider, the auditory epicenter for passionate property investors seeking a life of freedom, choice, and abundance. Today, I am joined by one of our very special guests, Claire Westra, who's one of our clients here at Dashdot. She's here to share her story of how she initially got into property investing. And I think there are going to be a lot of lessons or ideas in here that are going to be really useful for all of you listening out there. But first up, Claire, how are you feeling today?
Good. Excited. Happy to be here. Thank you for having me.
All righty. Well, let's jump straight into it. How did you get into property investing?
Big question. Okay. Well, we have to go back a bit. I had absolutely no direct financial lessons and very little financial literacy growing up. The finance lessons at home definitely stopped with never, ever, ever get a loan. Definitely don't get a credit card unless it's for a house, which I've kind of stuck to. But what I didn't get in financial lessons, I definitely picked up in our kind of weird family weekends. We'd always go to the tip and scavenge and get what we could and turn it into something else. I learned how to repair. I learned how to DIY. I learned how to use the internet and just put kids' toys on eBay.
University of life.
Yeah, absolutely. It definitely, taught me what I put in is what I get out. But fast forward a little anyway. I'm 23 and the Barefoot Investor was groundbreaking for me. It got me thinking about money. It got me thinking about my future. It had actually never ever occurred to me that I should be the one to support my own retirement, not the government. We're very lucky in this country. You just don't have to think about it. But, anyone who's actually read the book knows that the author doesn't really take a favorable view of real estate investing. And instead he recommends buying a house and kind of paying it down and buying ETFs to track the market. So I bought my PPOR on really low interest rates about 6 years ago with a boyfriend at the time in a little place called the Byron Shire. I don't know if you've heard of it. Crazy. I pulled 100K of equity, my first equity drawdown out, and I started investing it in the stock market, religiously dollar cost averaging month by month. But anyone who knows me knows that I'm impatient. It just wasn't fast enough. Unfortunately, the market crashed a few months later and I lost 30 grand. And it definitely made me take stock and really seriously consider what I had done. But it kind of revealed a little bit of a lesson to me. My PPOR's value had nearly doubled by my random chance purchase. Why the hell would I wait for, slow, gradual movement in the stock market? I'm not a stock picker. I'm not a trader. I should invest in property. How hard can it be? My assumptions were that it always goes up. I've done it before. Let's just do that again. At the time, I didn't have any knowledge in investing. No one I knew was doing it.
Was it a bit sort of trial and error? You'd tried property, you'd seen that it worked. You tried shares, you had a different result. So it's like, let's stick with the horse that keeps winning.
Yeah, it wasn't very motivating to see no change in my stock portfolio and then to have it drop by 30 grand, that's for sure. But yeah, I thought, well, I've made money here. Why would I be taking money out of the property that's gone up only to put it in something that's going to grow slowly? I don't know, I was very naive. So, no one I knew was doing it. I was quite young at the time and I was flush. I wish I could go back with borrowing capacity because my business was kicking off and the interest rates were extremely low. So I felt like I could buy anything. That's how I first started.
Okay. And your first investment property, what were some of the early assumptions that you may have had when it comes, like everyone usually, when they get their first investment property, the level of education and understanding people have around the property market is usually not at its peak when they're buying their first investment property. Usually there are some preconceived ideas, some biases, some early assumptions and things like that. What was your outlook at the time?
Yeah, it's quite embarrassing, but it's good to reflect on. I hope it's a lesson that other people can learn from. But I bought a hero property. It was based on retrospective data. I was reading all of these kind of random property forums, different random people's opinions, and it was at the top of the market. I can look back and see that now. 10Ks from Brisbane, using a huge amount of my borrowing capacity, totally emotional. I liked the look of it. The suburb had done so well, so I had this bias. And I thought, of course, that'll continue to grow. And it also had a shed on the back with potential to turn it into a granny flat. And I just knew so little. So spoiler, it's on the market now. This is a couple of years on. But I tried everything to make that property work. I attempted a retrospective conversion of the shed into a habitable granny flat, issues with slab depth and whatever. I tried to manage my own property to keep costs down. We did a new kitchen and a bedroom to force some equity and cash flow. But, I picked a dud. It's super negatively geared and it was just costing me huge cash flow annually. So, yeah, the more I looked into my next purchase, I realized I had made a bit of a bad choice and I didn't properly learn how to analyze properties correctly. I just sort of had to be blue chip. It had to be negatively geared. It kind of had to be maybe, a few extras through renovation or development. I can turn it into a good deal. But yeah.
I was going to ask, what was the reason at all that you thought this would be a good property? But I guess I can kind of see it because having worked in property for so long, the marketing that goes in from different companies pushing very, very specific ideas, usually because that's what their product is, right? Usually it's like, if they specialize in doing splitter blocks as a developer or something like that, or if they're a buyer's agency that specializes in granny flats or something like that, that's what they look at as a way of adding value. And so that marketing message can really, I guess, it can set people wrong because usually, or a lot of companies out there are sort of like, this is the silver bullet. This is what you need. It should be blue chip. Always buy blue chip, and that's just what their investment thesis is. Or always buy something with an added value opportunity, and it's not always the case. Sometimes it is, but we like to say at Dashdot that we are very sort of agnostic. We're strategy agnostic. It depends on the person, depends on individual circumstances, depends on what you need in order to achieve your goals. And being open to lots and lots of different strategies is going to mean you're more likely to find one that's going to get you there. Anyway, that's my little Dashdot plug. How did you come about Dashdot and decide that, yeah, well, actually, these guys might be a bit more useful?
Good question. Well, mainly I wanted to correct the mistake I had made with that Brisbane overcapitalization because I could see from my PPOR that property investing worked, and just not with that property. I think it really would have shaken the nerve of a lot of people, the losses that I was starting to absorb. Thankfully, I had my business to kind of prop me up, but it was just, it motivated me to go like, what the hell have I done? Like, how can I fix it? I needed a mentor, basically. But I still had a bit of a DIY mentality. So I kind of found the Investor Lab podcast, now the Dashdot Insider podcast. I found Terry Ryder's reports. I was still, kind of like, I can buy myself a tidy little property deal. I need to prove it to myself, So I went into a property in Toowoomba in its second upswing cycle, which has thankfully done well now. But, our vals didn't move much for like 12 good months, which ultimately, again, slowed my progression. And that was kind of towards the latter end of where my borrowing capacity could accommodate. So, I was really pissed off. Again, like the battles kept coming back as like, not move. I can't get that time back. Getting it wrong was a huge opportunity cost, and time is ultimately the magic ingredient. So, at this point I was like, okay, all right. I'll get some professional help. One thing that always pissed me off when I was doing my research was that, the data is so retrospective. It's so backward facing. I studied a couple of little scientific statistics courses at uni, but I didn't really know how to mash it all together. I didn't even know where to get all of the data, and I certainly didn't know how to like make it mean something. I started to look into who was doing predictive models, and that's when I found Dashdot actually. And that week, I had a portfolio growth plan created that week.
So it's the forward-looking predictive modeling that really helps. A lot of people are very, very data-driven. I know you're a podiatrist, so I imagine you're fairly data-driven as well.
Certainly.
I think a couple of interesting things you mentioned there. First is the time. Like there's an expression in property, right? Time solves all problems. If you can afford to hold on to a property, even if it were that blue chip property that you had, if you can hold it on for long enough, it's probably going to solve a lot of the problems because debt on it gets inflated away. If you get enough rental increases, then suddenly you're going to be neutrally geared and then positively geared, and time solves all problems. But it can be a real pain in the ass waiting for that to happen. You're just sort of sitting there, and
I'm so impatient.
Yeah. There are different ways of thinking about it, right? Some people can be sort of like, oh, I'm just throwing money away, which I don't think is entirely accurate, because if you mentioned a share portfolio, if you were putting $1,000 a month into a share portfolio, you would think of yourself as investing. Even if that share portfolio went down, you'd just be like, well, I'm still investing. I still believe in the stocks. Whereas when it comes to property, if a property is negatively geared for $200 a week or $250 a week, and people are putting $1,000 or $1,000 and change into that property, often people don't think of it as investing. They think of it as just a cost. Well, this property is now just costing me, without being able to factor in the growth. But what happens is that growth might not be happening. And that's the part that's emotionally really challenging, because you're sitting there going, well, it's costing me this money. And if I reframe how I think about it, well, I'm investing in it. But if it's not getting the growth, then it really does feel like you're throwing the money away. And especially when you look somewhere else, you look at a bunch of people who are using predictive data, and it's like, oh, well, their properties have gone up by 100 grand this year, while mine's cost me 15, and I'm sitting on the sidelines waiting for an opportunity. So that part I totally get. That part's really tough. The other thing you mentioned is like the data, looking at retrospective data. And a couple of weeks ago, Goose, myself, and Sean did a podcast on this exact topic. And it's really interesting because a lot of people like it. You can put whatever spin you want on data, right? If the property market has gone up a lot, you can say, oh well, it's peaked, it's topped out, right? If it has gone up a lot, you could also say, oh well, it's going up, so it's a good deal to buy now. It's going to keep on growing, right? Past performance is an indicator of future performance. And it sort of comes down to, have you heard of the gambler's fallacy or the Monte Carlo fallacy?
Tell me.
It was in the casino, Monte Carlo, the famous one. Black came up on the roulette wheel 28 times in a row. Now, the chances of that happening are 1 in approximately 246, 248, 250 million, something like that, but it actually happened. Now, if you've just seen black come up for the 28th time, does that mean that the 29th time is more likely to be black or more likely to be red? And so it kind of like probably depends how you're feeling on the day, right? If it's a fair table and you keep it, I mean, that thing must get spun a lot. But if it's a fair table, then it should still be 50-50. So past performance is not always a good indicator of future performance. You need to filter it by the other factors. Do we have a table that has a bias towards black? Or is it a fair table and it was just chance? And this is where statistics comes in, and statistics become really, really important, not just as data, but the way you can process those numbers and work out, okay, well, it's gone up by this much, but what do the fundamentals say? What is all of the data pointing to? Is it still going to keep on going up? Or is it going to go flat? Is it going to go up a little bit? Is it going to crash? Just because you have historic data, that's only one part of the puzzle of what's going to happen next. And what we're finding right now, so many people have this idea that I want to buy in areas that haven't had any growth because that means that they're going to have growth. But that's not necessarily the case, because COVID was like a macro unifying factor. And so many suburbs all just went up. So if you're looking to buy a dip, it's pretty hard to find a dip at the moment. because so many areas are just going up and up and up. I'd like to bring the conversation back to you, though, as well. I always love asking people about what their goal is. What's the dream? Why are you in the property investing space? And has that changed?
Yeah, well, good question. That one has really evolved a lot over time. What's been interesting is that it has shifted once I started investing, and throughout and after I got the portfolio planner. Quite literally, it shifted. It's actually been a really strange change within ourselves, within myself and my partner. I never before the portfolio planner really asked myself what I wanted in life. I definitely wanted to have and to not worry about money, but it was pretty poorly defined. And then, Dashdot's kind of like, you have to have an endpoint. If we're going to plan something for you, what do you want? And so we started out with the planner with the goal of a dream home and a farm. But the more we kind of learn about investing and about PPORs, the more our views shifted towards it's actually quite a very simple desire, but we want more time just to do whatever the hell we want. You can't manufacture time. It's probably the most valuable resource. So, and I qualify that fact with the fact that I'm an atheist, I'm a humanist, I believe we only get one life. And before investing, I wanted to gain as much time for myself by earning as much as possible, by working as little as possible. But now I've shifted that strategy completely. The desire remains the same. I want more time, but it's work hard now, make good investments, retire early, and enrich my life and my families and friends through travel and food and art and history and language by kind of traveling around the world. Like, that's our main goal. But, you end up doing so much good on the path to that goal. I think, it's made me more motivated to work and to develop a business, which offers a huge service to my community, and improves their life as well. So yeah, that's the goal.
How defined is the goal at the moment? Is it a specific number? Is it a specific farm or anything like that?
Yeah, so we've shifted away from the farm, and it's retire as soon as possible, and retire overseas. I think if it was to be within Australia, given the cost of living, that would be a little bit further away. But currently we're at 4 years. When we created the plan, it was, I think, 6 years. But, you guys are great. You allow us to do a lot of revisions, and we keep kind of tweaking and improving and tweaking and improving. So retire in 4 years. Yeah, that's the...
Okay. How many properties in total are in your portfolio at the moment?
At the moment, we're getting number 5 settled in September, and we have, I think, about 9 mapped out.
So you've got 9 properties mapped out. That's the plan. You've got 5, so you're 55% of the way there, which is obviously fantastic. So with 5, you would have, obviously, you have a lot of experience getting to 5, getting to 1, then getting to 2, and going up and up and up. What would be sort of like lessons or advice that you would have for people listening on how do you get to 5?
Oh, good question. I've taken probably a pretty active approach, but above all else, ultimately, I now know that the deal should look shit hot and shiny going in, and everything else is a plus. We've done multiple equity drawdowns, debt recycling, creating separate entities and trusts. Thank you, Jeremy Iannazelli, and going from, an employee. He's amazing. Love him. Going from an employee to a company directorship, and then just so many other things that I can't even list here. But I don't know. Lessons would be, when you're learning the art of investing, you'll constantly feel a bit like a fool. I certainly have, when the next phase or lesson kind of reveals itself to you. But you have to use that as a motivating factor. Had a bad decision in Brisbane. I'll tell you about rent investing if you want. But there's, you have to change your team as you grow. They directly impact your outcomes. Chances are you don't have the best broker and accountant if you're just starting out. We're not all created equal in our professions. So I realized this when I had to tell my accountant at the time about the new land tax laws in Queensland that are now repealed, and I was like, I shouldn't have to tell you about this. So I'm in contact with these guys pretty much every other week. I want to make my broker wealthy. I want to make my accountant wealthy because they're definitely helping me to do that. But the biggest thing I think that I've had to learn is like check your self-limiting beliefs. What are they? What are your weaknesses? You guys were, running off about rent vesting ages ago, and I already had a PPOR, and rents around here are quite expensive. But it wasn't until a house sitting opportunity came up that it occurred to me, I could rent vest. Why don't I move out? Should I run the numbers? And it was just this huge blind spot that I was sitting on a gold mine. We actually ended up, because I was a bit nervous about kind of putting all of our stuff into storage or whatever. I looked into testing that through Airbnb, and now that Airbnb is net yielding 10 to 12% net. So, what have you already written off as something you couldn't do? Is it rent vesting? Like, why can't you? Could you try what I did? Airbnb it for 6 months. I managed it myself. The platform's designed that way. So, any issues are pretty mild and far between. And it's like, I would honestly move into a tent for that kind of net yield.
How much is that one of the things that sort of reduced your timeline down from 6 years to 4 years?
Big time.
So just deciding, if you've decided that you're not going to settle down and live in Australia forever, right? Retirement's in another country, a more affordable country, presumably. Then why not just rent vest? Are you renting somewhere that you like?
Yeah, so we're not too far from our home. We're about an hour away. My partner has a block of units here in Lismore that we repaired after the floods, and we've put ourselves in one of those.
Okay. So you've got a block of units. You're there. It's totally fine. It's not like the walls are falling apart. It's totally
close to work. No, we repaired the whole thing to brand new. We sheeted it ourselves, 3 kitchens. Yeah, very active investing strategy.
Okay. And then by being quite active and thinking about Airbnb, even worst case scenario, if you had a long-term renter in there, long-term tenant, then you're still getting presumably a pretty awesome yield. Couple of creative strategies, Airbnb being one of them. Suddenly you're shaving years and years off your property investment journey.
Yeah.
Any other lessons from Airbnb?
I would definitely say with Airbnb, one thing you do need to be aware of is if you're managing it yourself, and the fees are quite prohibitive if you choose to have a professional company manage it, and it is totally doable, that you need to have a full year of income from that on a tax return to be able to find it useful for a bank. There are definitely higher running costs, of course, but, there's so many ways you can automate the stay now. The biggest amount of time that you'll spend is just, setting it all up. There's plenty of resources. Like there's this guy on YouTube, Airbnb Automated, shows you how to rank highly. There's Price Labs that helps you with dynamic pricing because you're essentially running like a tiny mini hotel. But those are just a few little things I picked up along the way that really helped.
Okay, so a couple of key lessons here. Definitely get professional advice, work out how to do it properly, and make sure that advice includes talking to your accountant or broker, because Airbnb can affect your equity drawdowns and borrowing capacity depending on how long you've been renting it out as an Airbnb. So that's going to be important, right? Make sure, if you're listening to this, make sure you get those things kind of locked down before you suddenly sort of run off and go, hey, honey, I've got a great idea. We're going to Airbnb our place. It's going to be great. We're going to get 10% yield. We're moving into this flat.
Do your due diligence, definitely.
Yeah, definitely do due diligence. But it sounds like a wonderful opportunity, definitely worth exploring for a lot of people. All right. Now, you have told me about something that you have referred to as your awesome purchase. You want to tell me about your awesome purchase? It
is pretty awesome. I think that word's overused, so it's a shame I've used it. But it's a bloody screamer. That was the first Dashdot purchase. We decided I'm a busy business owner now, so I don't have the time to find the deals. I'm certainly a lot better than I was, but you guys came to us with a duplex. It's a cash flow tilted property, and $490 purchase price, bringing in $820 a week. And it was funny as time progressed. It was Andy, the wonderful Andy in your team, who asked me a very useful question when we were redrawing the portfolio planner, the next year on. He was like, where else could you sell? You're selling the one in Brisbane. Where else could you sell and reinvest? Because we came with a couple of properties to Dashdot. And he was like, your timeline is so short and you want to retire in 4 or 5 years. So, we're going to need cash flow with growth potential. And that's kind of when I learned, I guess, another trick. You don't have to hold it forever. Don't be attached to the properties you may already have. It may make more sense to sell and cop the exit costs to get you to your goal faster. And because I could see that in the property that you guys bought, I don't know, it was evidence for me. Yeah, you know what? I don't care about what I'm holding. Like, how else can we go faster?
It's more of an emotionally painful experience rather than a financially painful experience, because the idea of selling a property that you've bought, it's like, but I bought that and I thought about it and I was really excited.
Yeah.
And we had a series of little celebrations, right? We got the offer accepted, we popped the champagne, then we got finance approved, we popped the champagne again, and then we're all happy when it's settled, right? It's a series of small celebrations. Then it's like selling it usually feels like you have to because you've made a mistake. And so that's something that often we don't want to sort of admit. We don't want to go, it's much easier just to say, no, it'll come right. It'll come right. It'll be fine. Just wait a bit longer. Next year will be a big year. It's much easier to take that approach rather than, to bite the bullet. Don't throw good money after bad. Say, actually, it might come right, but I feel way more confident that this one over here is going to fit our portfolio needs a lot better. And this is something a lot of people have actually asked us about. So many people have portfolios out there at the moment that are suboptimal in terms of what they could do with the equity that's in them, right? And we've talked to people that have 3, 4, 5 properties, and sometimes it can be a case of, look, none of them are good. None of them are doing what you need them to do. Or sometimes it might be, this one and this one, right? You've got equity in them. They're not really helping you. Here's what our predictive model's telling you. So maybe you're going to be better placed to get this property and this property instead. And we're always, you mentioned it was a cash flow property. We're always trying to solve for the theory of constraints. If you've listened to this podcast at all and listening to it now, you've probably heard us talk about the theory of constraints. But it's just such a fundamental truth that lenders, your ability to invest and grow your portfolio comes down to your ability to service cash flow, capital, and get credit. And credit is often a function of the first two, right? If you've got cash flow and you've got the capital, you've got the equity, then most of the time you're going to be able to get the credit unless you've got, something really wrong with your situation. The property you're trying to buy is just way too dodgy. There's a postcode sensitivity around it, or there's something wrong with it, or there's something wrong with you if you've had to declare bankruptcy, or you have a bad credit rating for whatever reason. If there's something like that, then yeah. But most of the time it's cash flow and capital. And working out how to balance your portfolio to optimize for those things with your next property purchase and the purchase after that, and most importantly, the purchase after that, because you don't want to get stuck. So with all of that borne in mind, right, you've got this fantastic cash flow property, you're doing the Airbnb thing, you're accumulating, you're on your track for 4 years. What would you say then to somebody starting out now?
On the other side, I know what's kept our purchasing power going, and it's definitely look at ways you can increase your income. Most people can turn their day job into a business somehow, even if it's part-time at first. But, there's often a voice in your head kind of stopping you, and that's that self-limiting thought. And Goose does a really good job of kind of talking about that, and Gabby. There's so much you can do when you have a business structure in place that will accelerate your portfolio, by remembering the outcome of what you're trying to achieve and actually seeing it on a timeline and showing it to your partner who needs to kind of be visually on board as well. Like I say, put it to yourself as a trade-off. If I increase my income to this, I could get to this goal this much faster. Ask your planner to kind of map it out. It may not be as far away as you thought. And of course, get professional advice. I think that's been an overarching lesson of this.
Yeah, I think the advice piece is something that maybe it's a hangover from the way people used to look at the property market 10, 15, 20 years ago. I've worked in marketing and I've worked in property. And if anyone you ever meet in Australia or New Zealand tends to be an expert in property and an expert in marketing, right? You're at a barbecue. Everyone knows everything about property, right? So many people are out there and they're trying to do it on their own, right? And conventional wisdom around property, buy in these sorts of areas, buy this kind of property, it's worked for so long. It's like, anything, right? It works until it doesn't. And that kind of conventional wisdom, no, I can just do it myself. I can manage the property myself. Yeah, it's got a shed on the back. All of this sort of thing doesn't really stack up when you compare it to getting professional advice, talking to an accountant like Jeremy or a broker like Callum, getting that advice that suddenly structures everything differently. And it's like, wow, and the opportunity cost of sticking with, conventional, I'll call it wisdom with the air quotes, the opportunity cost there is absolutely massive. Now, naturally, I would say this, working for a property-related company, but we just see it with so many clients. So many clients have portfolios that are a little bit messed up. How much was the portfolio plan a game changer for you, if at all?
Incredible, remarkable. If you don't have a portfolio planner or a version of that, you are relatively steering blind, is the way I feel about it. I didn't realize how far advanced in we were to getting to our goal. And you could end up just making a massive mistake by buying the wrong property. Stop worrying about hotspots and what to do with 500K. I would shop on podcasts just to find, where are people buying. It may not be relevant to you, Start considering your outcome, your main goal, and actually mathematically work backwards from there. You'll sleep better at night. You'll feel better. Your partner will be on board. You definitely are going to have to spend a little bit of money to make that money. But it was, for me, the best money I ever spent because I felt reassured that, I had to hit save. I'm going in the right direction. I can see this is like the best worst case scenario here laid out for me. So invaluable.
All right, then. Any final thoughts then for anyone listening out there?
I would say pay it forward. If you're an investor already, rising tide floats all ships. I started my business because someone in the industry reached out and asked if I'd ever thought of doing it. They turned into a valuable mentor, and I'm forever grateful. It's definitely accelerated my portfolio, and I guess a thank you to Dashdot. The last property you bought for us was while we were having the time of our lives. We were in the Amazon rainforest at the time, and we definitely couldn't have done it without you. You've given me my time back, and given me a lot more confidence in our future going forward.
Okay. That's awesome. Well, if you're listening to this, definitely sounds like we've got some very, very important lessons there. A lot of preconceived biases have had to be eradicated in order for you, Claire, to achieve what you've been able to achieve. And things are looking pretty good for the next 4 years. Might be a reasonable chance, given the way that the market's performing. Might even end up being 3.5, something like that. Who knows? We'll see.
Hopefully.
Thank you very much.
I'm ever the optimist. Thank you, Emil. Lovely to meet you.
Likewise. Thanks so much for jumping on. And to everyone listening, we'll see you in the next podcast. Cheers. Bye.